Every financial crisis in history was called a once-in-a-generation event. And without fail, it happened again and again and again. The 2008 crash, the dot-com collapse, the savings and loan disaster, the Great Depression. Each time, the same words. Nobody saw this coming. But somebody always did. The real question isn't why crises happen. It's why we keep pretending they won't. Most people experience a financial crisis the same way. They didn't cause it. They didn't see it coming. And they paid for it anyway. In 2008, roughly 10 million American families lost their homes to foreclosure. Not because they were reckless, not because they were foolish, because they were inside a system that failed, and the failure landed on them first. Unemployment doubled in 2 years. Retirement accounts lost trillions in value. Small businesses that had operated for decades closed in a matter of months. And yet, within a few years, the stock market had fully recovered. Corporate profits hit record highs. The people at the top of the system bounced back quickly. The people at the bottom are still recovering. That asymmetry isn't an accident. It's a feature. Because financial crises don't just destroy wealth at random. They redistribute it. And the direction it moves almost always follows the same pattern. To understand why, you need to understand something most people are never taught. Financial instability isn't a malfunction of the system. It is the system. Meet Tyler. He's 32 years old, living in Chicago, Illinois. He works in logistics coordination for a mid-sized shipping company. He earns $58,000 a year. After taxes, rent, utilities, groceries, a car payment, and student loans, Tyler saves about $200 a month. Some months, less. He's not bad with money. He doesn't take vacations he can't afford. He doesn't carry a big credit card balance. He just lives in 2024, where costs are high and wages haven't kept up. In 2021, Tyler noticed something. Everyone around him was talking about the market. His coworkers were buying meme stocks. His cousin tripled her money in crypto. A neighbor refinanced his house and put the cash into index funds. The numbers seemed to be going up for everyone except Tyler. So he started reading. He opened a brokerage account. He put in $1,500, almost everything he had saved. He bought into a tech-heavy fund right at the peak. Within 8 months, his account was down 40%. He didn't panic sell. He held on. But his confidence was shaken. He told himself the market would recover. What he didn't understand was why it had crashed in the first place. He didn't understand that the crash wasn't random noise. It was the end of a cycle that was always going to end. Tyler's story isn't unusual. Millions of Americans made their first real investment during 2020 and 2021, right at the top of one of the most inflated markets in modern history. Not because they were greedy, because they finally had the time, the tools, and the encouragement to participate. And they arrived just in time for the correction. Here's the first thing the system never explains to you. Bubbles don't look like bubbles from the inside. They look like opportunity. In the late 1990s, the NASDAQ index rose over 400% in 5 years. Technology was genuinely changing the world. The internet was real. The potential was enormous. The problem wasn't the idea. The problem was the price. Companies with no revenue, no profit, and sometimes no product were valued at billions of dollars. Investors weren't buying businesses. They were buying stories. And they kept buying because prices kept going up. And prices kept going up because everyone kept buying. This is what economists call a feedback loop. Rising prices attract more buyers. More buyers push prices higher. Higher prices attract more buyers. It works beautifully, right up until it doesn't. In March 2000, the NASDAQ peaked. By October 2002, it had lost 78% of its value. $5 trillion in paper wealth vanished. Real companies collapsed. Real people lost real jobs. But here's the part that gets overlooked. The people who got out near the top didn't get out because they were smarter. They got out because they had other options. Institutional investors, hedge funds, senior executives with stock options. These aren't people who need to hold on and hope. They have advisors. They have flexibility. They have information the public doesn't always get first. The average investor, like Tyler, isn't playing a different game with different rules. They're playing the same game, just always a few moves behind. And the same pattern played out more recently than most people realize. In February 2020, markets were at all-time highs. The economy looked strong. Unemployment was near a 50-year low. Confidence was everywhere. Then a virus spread across the world. In 33 days, the S&P 500 fell 34%. It was the fastest crash of that magnitude in market history. 22 million Americans lost their jobs in 2 months. The Federal Reserve responded immediately, cutting rates to zero and injecting trillions of dollars into the financial system to prevent a total collapse. It worked in the narrow sense. Markets recovered within months. But that flood of cheap money had consequences. With interest rates at zero and stimulus checks arriving, millions of Americans did something they had never done before. They opened brokerage accounts and started investing, including Tyler. The market that looked like opportunity in 2021 was largely a product of emergency monetary policy, a system pumped full of liquidity that had to go somewhere. When the Federal Reserve began raising rates in 2022 to fight the inflation that followed, the air started coming out. Different trigger, different decade, same feedback loop, same ending. The second hidden rule is even more uncomfortable. Crises don't just happen because of greed or stupidity. They happen because of leverage. Leverage means borrowing money to make a bigger bet. It amplifies gains on the way up. It amplifies losses on the way down. And the entire modern financial system is built on it. In the years before 2008, major investment banks were operating with leverage ratios of 30-1. That means for every $1 of their own money, they were controlling $30 in assets. If the value of those assets rose by 3%, they doubled their money. If the value fell by 3%, they were wiped out. For a while, it worked. Housing prices had never fallen nationally in modern American history. At least, that was the assumption. Mortgage-backed securities, bundles of home loans sold as investment products, were rated as safe as government bonds. They were not. When housing prices began to decline in 2006, the math unraveled quickly. Banks that were leveraged 30-1 didn't have enough cushion to absorb the losses. Lehman Brothers collapsed. Bear Stearns was sold in an emergency deal. The entire interbank lending system froze, and the government stepped in with $700 billion in emergency funding to stabilize the banks. Not the homeowners. The banks. This is the part of the story that most people intuitively feel is wrong. The institutions that created the problem were rescued first. The people who were sold mortgages they couldn't afford were left to navigate bankruptcy and foreclosure largely on their own. Leverage privatizes the gains. Socialized losses is what happens when it fails. That's not a conspiracy. That's a documented pattern that has repeated itself across every major financial crisis for the past 100 years. To understand why crises keep happening, you have to understand what the financial system is actually designed to do. Most people think it exists to help the economy grow. That's partially true. But it also exists to generate returns for the people who own financial assets. And generating returns requires risk. Risk requires leverage. And leverage, when it accumulates across an entire system, creates fragility. Think of it like a building. A building with a flexible foundation can absorb small earthquakes. But if every floor has been reinforced to hold 10 times the normal weight, and every beam is under maximum stress, a single crack in the foundation can bring the whole structure down. This is what the economist Hyman Minsky described in a theory that was largely ignored for decades. Minsky argued that stability is destabilizing. When the economy is doing well, people take on more risk. When risk seems to be paying off, they borrow more to take on even more risk. When everyone is borrowing and speculating, asset prices rise. When asset prices rise, it looks like the risk is working. This continues until it suddenly can't. Minsky called it the Minsky moment. The point when debt levels become unsustainable, confidence collapses, and a cascade of selling begins. It happened in 2008. It happened in 2000. It happened in 1987, in 1929. It happened in March 2020, when the pandemic triggered the fastest stock market crash in modern history, erasing years of gains in weeks before an unprecedented government intervention stopped the fall. And it happened again in 2022 and 2023. When the stimulus-fueled boom that followed collapsed under rising interest rates. The Nasdaq fell nearly 35%. Silicon Valley Bank, a bank that had loaded up on long-term bonds during the low-rate era, failed in 48 hours when those bonds lost value. It was the second largest bank failure in American history. Not as a coincidence, as a cycle. But here is the question that never gets answered. If this is a cycle, why don't we stop it? Why does every generation walk into the same trap? Part of the answer is memory. The people who lived through the Great Depression carried that fear for the rest of their lives. They saved obsessively. They avoided debt. They didn't trust markets. But by the 1980s, most of them were gone from the decision-making table. A new generation had taken over. One that had only read about the Depression, never felt it. And slowly, the guardrails that generation had built began to be dismantled. The pattern repeats roughly every 20 to 30 years. Long enough for the memory of the last crisis to fade. Long enough for a new generation to believe that this time is different. There is also a structural reason. Financial institutions are not rewarded for caution during a boom. A bank that stops lending because it sees risk accumulating loses market share to the bank that keeps lending. An investment fund that sells early because valuations look stretched underperforms its competitors and loses clients, right up until the moment the crash proves it right. The system punishes caution and rewards risk-taking, precisely when risk is most dangerous. That's not a flaw in the character of the people involved. It's the logic of the incentives they are operating inside. The irony is that after each crash, the conditions that caused it are eventually rebuilt. Interest rates drop to encourage borrowing. Asset prices rise. Confidence returns. Risk appetite expands. And slowly, quietly, the next bubble begins to form. Tyler eventually learned what had happened to his account. He read about Minsky. He read about the history of financial cycles. He came to understand something that most people never get taught in school. The timing of when you enter a market matters more than almost anything else. Not because markets are random, but because the cycle has a direction, and your position in it determines your outcome more than your effort or intelligence. This is the part that feels deeply unfair. Two people can make the exact same financial decision. One makes it in 2012, when asset prices are recovering and cheap. One makes it in 2021, when asset prices are elevated and fragile. The first person looks like a genius by 2022. The second looks like a cautionary tale. Same decision, different outcome. Different position in the cycle. Now consider where we are in 2026. The last major systemic shock was in 2020. The correction that followed peaked in 2022. Since then, markets have largely recovered and, in some sectors, reached new highs. By historical measures, we are roughly 6 years into a recovery phase. The average cycle between major crises, going back over a century, runs somewhere between 8 and 15 years. Though the timing is never precise, and the trigger is never the same, that doesn't mean a crash is imminent. It means the conditions that precede crashes, rising confidence, expanding debt, increasing leverage, the gradual erosion of caution, are likely already building somewhere in the system. They always are at this point in the cycle. The question is never whether it will happen. It's whether you'll be positioned to survive it when it does. And here's the deeper layer beneath that. The people who consistently profit from crises aren't just lucky. They have the financial cushion to wait. When markets collapse, prices fall to levels that represent genuine long-term value. Distressed properties, undervalued stocks, discounted assets of every kind. But to buy at the bottom, you need capital at the bottom. And capital at the bottom requires that you weren't fully exposed at the top. That requires a safety net, a reserve, the ability to hold on while others are forced to sell. Most Americans don't have that. A 2023 Federal Reserve survey found that roughly 37% of American adults could not cover a $400 emergency expense without borrowing or selling something. For those households, a financial crisis doesn't just reduce their portfolio. It forces them to liquidate at the worst possible time. The people who profit from crises are not more disciplined than everyone else. They are more insulated. That insulation is what allows them to be patient. And patience in financial cycles is almost the entire game. Tyler still has his brokerage account. His portfolio is slowly recovering. He's still in Chicago, still saving $200 a month when he can. He hasn't solved the system. He hasn't found a secret exit. But he understands it now in a way he didn't before. He knows that the next crisis will come. Not because someone will make a catastrophic mistake, but because the conditions for crisis are being rebuilt right now, as they always are, quietly, beneath a surface that looks stable. He knows that when it comes, the people with the most will lose the least. And he knows that understanding the cycle, even imperfectly, is still better than believing it doesn't exist. There's a line from Minsky that most economics textbooks skip. He said that the fundamental instability of capitalism is upward, not downward. The system doesn't fail because people are too pessimistic. It fails because they become too optimistic. Because confidence builds on confidence. Debt builds on debt. And the longer it holds, the harder it falls. Financial crises aren't the result of the system breaking down. They are the result of it working exactly as designed. The people who understand that don't live in fear of the next crash. They live differently inside a system that will always produce one. And that difference between understanding the rules and simply obeying them is the only real edge that was ever available to anyone.